If you can hear me, I just need one person to type in the chat box that you guys can hear me. I guess you can. So we got some good news from DermTech. After the market closed, DermTech reported that they are ready to launch their PLA Plus product. So PLA stands for Pigmented Lesion Assay, and the PLA Plus is just has at least one more indicator in it, which makes it more what they call sensitive, which just another fancy word for more accurate. So I believe it's over 99% now. I mean, when I did the interview with John Dobak, the CEO of DermTech, about a month ago, he said it was coming, but they just didn't know exactly when, because I believe that indicator that's added to the original PLA, I believe it was used in a lot of COVID testing. So they didn't want to use up that supply until they knew that, the pandemic was coming to an end, and then there wouldn't be a shortage of that particular ingredient, if you want to call it that. So I think we all knew this was coming, but it's still great news for DermTech. But the story is clearly not over. The two big catalysts for DermTech are going to be later this year when they roll out Luminate, and then next year when they roll out Carcinome. And Luminate is going to be their kind of skin analysis, DTC, direct to consumer, most likely, although there is a chance it goes to the dermatologist. John didn't want to really say which way they were going to go, but I could see them doing one or the other or both. But that's a way for individuals or patients to get an analysis of their skin and how much UV damage has been done, which obviously is an indicator for skin cancer in the future. So exciting news after the market. Stock's up, I think, 8 or 9% still. So hopefully we get the follow through tomorrow. No, call's not started yet. We'll start in like 30 seconds or so. So I am recording this. So if anyone has to jump off early, it is being recorded. I will upload it. So actually first, I think tomorrow I'll send it out to all the Substack subscribers on both paid and free. So you can watch it again if you want, or if you have to jump off early tonight, you can, finish up watching it tomorrow. And then I will most likely upload it to my YouTube channel. But I'm not 100% sure on that yet. Yep, I do have some thoughts on INTZ, which we'll get to. Actually, the company came out with a rebuttal today as well, which is good. It wasn't super convincing, but at least they put something out there. Okay, so let me start off. So thanks everyone for joining. You are all subscribers of my Substack. And, given the recent volatility in the markets, I just thought it'd be appropriate to come on and host something and, kind of give my thoughts on what's going on in small cap stocks and why we've seen this big sell-off, which some of you probably follow more than others. What stocks I still like, why I've sold some stocks, even stocks that I've done write-ups on, and I'll try to explain that. And what else? Sorry, I'm like trying to read the chat while I'm talking, which is not easy. It's easy to get distracted. So, okay, let me just kick off. So first 6-8 weeks of the year were incredible for small cap growth investors, including a lot of my stocks. I was up pretty big on the year. I'm guessing a lot of you were up pretty big on the year. The 4 write-ups that I did in December were Upstart, Futu, Mohawk, and Stick, STIC, which is the SPAC that is merging with BarkBox to take BarkBox public. I did the write-up on Mohawk when it was at 12. It's now at 23, so technically it's almost a double, but the stock went up to 48 a couple months ago, so it's 50% off the highs. So if you got in really early on Mohawk with my original write-up back in December and didn't add to your position at all in Mohawk, you're probably still very happy with that position. If you continue to add to Mohawk through the first, 2 months, 3 months of this year, and then you continue to add on the pullback, you probably have a higher cost basis than what the price the stock is currently trading at, and you probably have an unrealized loss in your portfolio, and you're probably not so happy. I currently have a loss on Mohawk. So even though I got in at under 12, I'm still very bullish on the company for the next few years. So I have continued to add to that position on the way up and on the way down. So Mohawk is now one of my largest positions, which I'm fine with. I understand the company pretty well. I still believe in their business model. I believe in management. I like their strategy. So just to kind of recap for anyone that does own Mohawk. So they have kind of two pieces to the business model. The first piece is we are going to use our AMI, our proprietary AMI software, and AMI stands for AI Mohawk e-commerce. What's the last E? I forget. Engine. So what they do is AMI is a proprietary software they built, although I think they do have it for license, or it is sort of a SaaS product if other e-commerce companies wanted to pay for access to AMI. I don't think too many are paying for it. Although recently there was a video that went around on Twitter where one of my friends interviewed the founder and he gave a sneak peek of AMI. And I think it was actually pretty impressive. So I wouldn't be surprised if some e-commerce companies saw that and now they're reaching out to the company to, talk about, getting access to AMI as well. But what they do is they use AMI to help identify opportunities in categories across Amazon, Walmart, Target, which are three of the marketplaces that they sell on, although Amazon is like 90% of their business. And then they have Shopify stores for each of their brands. So Mohawk has, I think it's 13 brands right now, but I don't know if that actually includes the recent acquisitions or not. So let's say it's somewhere between 13 and 15 brands total, and then hundreds of SKUs, of course, across those brands. And each of those brands has their own Shopify store. But once again, the majority of those sales are happening on Amazon. But they use AMI to help identify categories where there is not a true market leader, or the market leader is not doing a great job of meeting demand, or they just don't get the best reviews and ratings. And then Mohawk will work with their overseas design and manufacturing partners to create a product, manufacture that product, ship that product into Amazon warehouses, and then start to, work their way up the search results, I guess you want to call it that, and try to fill the demand with a higher quality product in that category. And they've been very successful at that. And they're, I call that the organic growth, because those are the products that they're creating themselves. So they're creating it, they're launching it, and then they're growing it essentially from scratch. And that business is growing probably 40, 50, 60%. And then there's this new side of the business, which they started getting into last year, where they're actually going out and acquiring other e-commerce brands. So they did one acquisition earlier this year, Healing Solutions, which is an essential oil brand. And then most recently did one Paper Direct, I believe was the name of the company. So these aren't like exciting, sexy businesses, but typically they are category leaders on Amazon. They've been around for a while, so they have a strong track record. In some cases, they have a great loyal customer base that's, that recurring revenue auto ship. So it's pretty predictable revenue, and it's a very profitable business. So they have great margins, free cash flow, and, but a lot of times those brands were started 5, 10, 15 years ago by a couple people, and, they're ready to do something different. They're looking to exit that business and move on with their lives, looking for some liquidity, probably 50 other possible reasons. And Mohawk can come around, and Mohawk also uses AMI to identify categories where there might be an opportunity to do some M&A. And that's where Mohawk will approach some of these brands and try to work out an acquisition where they're buying these companies for 3, 4, 5 times EBIT. And I think they're pretty clear about what they want to do with these companies. Is they're not looking to take 100% of that company and move it into Mohawk or absorb the entire business. They're looking really just to keep the products, the revenues, the ratings, the reviews, and get rid of the people and get rid of a lot of the overhead or overhead or overlapping costs and expenses, which is people and sales and marketing and maybe some legal and other operational expenses, which means if you're cutting out a lot of that fat, you're dropping more of those revenues down to the bottom line as profits. So I kind of call Mohawk a kind of a publicly traded private equity firm that is acquiring e-commerce brands. And that's what we call this roll-up strategy. So I'm very bullish on Mohawk still. The company's already guided to about 360 million in revenue this year in terms of 2021, with about 31 million of EBITDA. So a couple of days ago, the stock actually got down under $20. Actually, I think that was yesterday morning, got down under $20 for a few minutes. I believe that at that point, the stock was trading at like 20 times EBITDA with the 100% top line growth and a massive M&A pipeline. So there's a lot to like about the story. So it's continued to be one of my biggest positions this year, and I'll continue to add to it over time. So I'm not selling that anytime soon. Futu is another one that I wrote about very early when the stock was around 40, and it's now trading at 136. It did get up to 205 back in February, so it's pulled back, actually pulled back from 205 under 100. So it actually pulled back about 50% from the all-time highs to, what were the lows about a month ago, and then it sort of climbed back. It climbed back up to 175 a couple of days ago, and then they announced a secondary offering, which means they're issuing more stock, which dilutes the current shareholders. However, Futu already has very strong fundamentals. Last year, they grew at about 212, 213%. This year, they should grow at least 120, maybe 130%. They have 58% EBITDA margins, 48% net income margins, which is just insane. I don't know if there's another company out there that has that sort of growth with those sorts of margins. Typically when you see really high growth companies, they're typically losing money, or they have very, very razor thin margins in terms of EBITDA and net income. So Futu is absolutely an outlier in terms of their fundamentals. But I think what people are missing here is they didn't raise the cash because they had to, in terms of meaning they weren't burning through all the cash they had. Their operating expenses were not out of control to the point where they were burning all the cash on the balance sheet, losing money every month, and now they have to go out and raise capital in order to continue growing. What they did, or at least as I understand it, they raised that capital so that they can start offering more margin to their existing customers. And for anyone knows how these trading companies, these stock trading apps work, the more people have on margin, the more trading they can do, the more volume they can do, more options they can do, which in turn means more revenues for Futu. So by adding that extra $1.3 billion to their balance sheet, it should enable them to increase that revenue growth and most likely, because they're a very asset-light business, actually increase their existing margins or their current margins. So, it's possible that we could see that 58% EBITDA margin going up and that 48% net income margin going up because of the additional margin that they're now able to offer their customers. So those were two of my first write-ups. So Stick, right? So I got a lot of questions from you guys, probably 200 or 300 questions on that form that I sent out yesterday. And a lot of them were about, why would I write about a company and then sell it a month or two later? And which is fair, right? If this is going, if my Substack is going to be a weekly newsletter, that's 52 stocks a year. I can't hold 52 stocks in my portfolio. That's just way too many stocks. I actually did get up into the low 50s a couple months ago, which was absolutely ridiculous. There was no way I should have had that many stocks in my portfolio. Trying to manage that as one person is just, it's not feasible. So I was reckless to have that many stocks, but part of it was the pressure I felt to own the stocks that I had written about and to keep coming up with new ideas that I could talk about on Twitter or Substack, thinking that people were sick of hearing about my main ideas or my core holdings, and I had to keep coming up with these new stocks, to keep people interested. And that was the wrong strategy. That was a mistake for me. I need to do what's right. I need to manage my portfolio how I see fit. And if other people don't like it, then that's just too bad for them. So I still do like BarkBox, AKA Stick. This SPAC merger is taking forever, which is probably one reason the stock has not traded very well. Although most of the SPACs recently have not traded very well. So Stick has pulled back with a lot of them. The fundamentals still look very strong. I believe revenue growth this year is projected somewhere between 50 and 60%. Gross margins, I believe, are still around 55, 60%. Retention rate, I believe, is still around 95%. If you look at Chewy, I mean, Chewy is they have 35 or $40 billion company now. And I believe BarkBox was somewhere like less than 10% of that. Yeah, Chewy's a $33 billion company right now. Obviously, it's a very different business model. Chewy is primarily selling other people's products to their customers, whereas BarkBox is actually creating their products themselves and then selling those products to their customers in these subscription boxes. But their products are now available on e-commerce sites and even in brick and mortar retail stores. So I still like BarkBox, but here's the deal. Just because I write about a stock doesn't mean I'm going to own it forever or love it forever. You know, my opinions change on companies. I think the part that's throwing people off is like the fundamentals that got me attracted to these companies in the first place have not changed. But what happened is when we got that pullback in growth stocks at the end of February, I realized I had way too many stocks in my portfolio. So, you know, when the markets pull back, let's say, you know, my stocks pulled back 10%, you know, traditionally I'm going to cut off the bottom 10% of my portfolio and use that cash to add to my other names, my higher conviction names. Because even though a stock that goes into your portfolio, you should have a high conviction on every stock in your portfolio, that's just not realistic. I mean, you are going to have different levels of conviction on your stocks, which is what should determine the allocation of those stocks in your portfolio. I mean, your highest conviction names should be your largest positions, unless, well, I mean, there's an argument to be said. So it's you know, my position sizing is based on my conviction as well as the risk and reward. So even though I might love a stock and think it has the highest chance to be a, let's call it a 10 bagger in my portfolio, which means that the stock price would go up 10x. If I thought a stock had, you know, like ClearPoint. So I think ClearPoint has the potential to be a 10 bagger over the next 5 years. But there's still things that could go wrong. It's still a very small company with a small market cap. You know, there's always the risk of competition. I mean, there's a lot of things that could go wrong. Even though I think it could be a 10 bagger, and there's a few others in my portfolio that I think could be as well, I'm not comfortable enough having that as my top position. So that's why ClearPoint is in the middle of my portfolio with a about an 8% position, which is still pretty sizable, but I have a more concentrated portfolio right now than I did 2 months ago. So even an 8% position only gets you to like the sixth or seventh largest position in my portfolio. So I think what went wrong for a lot of people was because my performance for the first 8 weeks of the year was so strong, a lot of people started following me on Twitter, or I guess Twitter, Substack, StockTwits. And because I was publishing my portfolio on Twitter, right, in that Google Sheets, a lot of people said, "Oh, okay, Jonah's up 100% year to date. He must know, you know, he must know what he's doing. I'm just going to copy his portfolio. I'm just going to mirror all of his positions." So, you know, DermTech was one of my biggest positions, Food2, Upstart. But at the end of February, all they were doing was buying these stocks at their all-time highs. And I had not added to those stocks in quite some time. I mean, I really hadn't added to DermTech once it got into the mid 50s. It ran all the way up to 84. I didn't add anywhere between mid 50s and 84 because it obviously, to me, it felt like it was getting very overextended and it was due for a pullback. Now, shame on me for thinking it was overextended and not trimming it back. But this is the dilemma that I've dealt with all year: is when do I start trimming my stocks? When do I want to create short-term capital gains for myself? Because if I still believe in these companies long term, and I'm going to hold these stocks for the next 3 to 5 years, what's the point in trimming them now, just to hope that they actually pull back so that I can buy those shares back cheaper? Now, I think the argument for trimming makes more sense if you think that one of your stocks or a couple of your stocks have gotten very overextended and some of your other stocks have pulled back unfairly. Then I think that's a stronger argument for trimming some of your overextended stocks and adding to some of the stocks that have pulled back. So, let's just say tomorrow, well, let's just say in 2 weeks, DermTech is back in the 70s or 80s, and it's, 25, 30 percent above the 10-day moving average, which would be pretty extended, then I would trim back that position. And let's say, Grow Generation or AudioEye or Dario Health, one of these other stocks in my portfolio, had pulled back and it was, kind of sitting on the 50-day moving average, or in this case, like Dario Health today, or a couple of days ago, actually pulled back to the 200-day moving average, then I think that you can argue that it makes sense to trim some of your DermTech in that scenario, or let's say Upstart took off or Futu took off, trim some of those stocks back, and then add to some of the stocks that have been laggards in your portfolio. Now, some would argue that that's not right, that you should never trim your winners to give to your losers. But I don't look at my laggards as losers, because my mindset is, while some stocks are zigging, some stocks are zagging, they all have, different catalysts at different times of the year that are going to move some stocks, up now, and then other stocks have to wait for those catalysts to play out and then they can move higher. So if I know that if DermTech moves up 20, 30% on the catalyst that I was expecting them to, and, Dario Health has a couple catalysts that might come through in the next month, then I could argue that it would make sense to trim back on DermTech and add to Dario before those catalysts, hopefully play out the way that I expect them to. So, that's why I'm moving money around from one stock in my portfolio to another. If I cut a stock or sell a stock, especially if it was a recent write-up, I'm normally doing it because the markets have pulled back, volatility has been going up, and at that point, I just feel more comfortable concentrating my portfolio into a smaller number of stocks or holdings. So, when the market was going gangbuster back in February, I got out of control and I had over 40 stocks in my portfolio. And then as the market started to pull back, my portfolio shrunk as well. Like I said, I was, every time my portfolio dropped 10%, I would cut out the bottom 10% of my stocks, my 10, let's just call it the 4 or 5 lowest conviction stocks in my portfolio, use that cash to add to my higher conviction name. So, and BarkBox was just one of them, and Porch was another. When I did the write-ups on both companies, I was very bullish on both companies, and I would argue that I'm still bullish, for the next 2, 3, 4 years on both companies. But I don't like either one of them as much as I like Upstart, or as much as I like Futu, or as much as I like Celsius or ClearPoint. I think those stocks have more upside over the next 3 to 5 years than BarkBox or Porch in this case. Doesn't mean that you can't still own Porch and BarkBox if you still like those companies. But once again, I have to do what's right for me in my portfolio. The other thing that I have to be mindful of is what will the stocks do if I announce to all 35,000 of my Substack subscribers that I've sold a stock? Is the stock going to drop 15, 20%? And is that really fair to the other subscribers that bought the stock and didn't sell it and still like the stock long term? So I have to try to balance that out. In addition to that, my Substack is really for these weekly write-ups. And then, of course, I send out some interviews once in a while. I don't think the people on my Substack, I don't think the majority of them want to keep getting these daily alerts as I tweak my portfolio. That's really what my stock twits room is for. And I have to separate the services because they're two totally different types of investors. I think the longer term investors that are really looking for these small cap stocks that can be these 5-baggers over the next 5 years, I think those are the people that tend to gravitate towards my Substack, and they're hoping that I can help them find some of these companies. And through my due diligence, they can build up conviction in these companies as well. And they're planning to hold these companies for the next 2, 3, 4 years. And that's fantastic. I hope that I get to hold some of my companies for that long. I mean, I'm planning to hold, things can change, but I'm planning to hold DermTech and Mohawk and ClearPoint and all these other stocks for the next 3 to 5 years. But I don't want to announce to everybody that I've sold a stock, 36,000 subscribers, and crash the stock by 15 or 20%. I just don't think that's fair to all the subscribers. And at the end of the day, any stock that you buy or sell in your portfolio should be a decision that you're making, on your own after you've done your own due diligence on the company. You shouldn't just, follow me just because I'm doing something, because at the end of the day, if you just follow me into a stock and that stock goes up or down 20% and you don't even understand that company well enough, then how do you really know what to do? How do you know if you should trim that position, or if it pulls back, should you sell it or add more? So I really want all my Substack subscribers to understand these companies as much as they can so that they can react to the up and down, movements in these stocks as well. Two other stocks that I sold recently that I plan to get back into, and here's why I sold them. So SBG, which is Owlet Care, which makes these, the baby sock monitors, and Fuse, FUSE, which is the SPAC that is going to merge with MoneyLion. I still like both companies. I mean, MoneyLion just reported preliminary Q1 results the other day that looked really, really strong. So I think that company's doing a lot of the right things. The fundamentals look strong. The story seems intact. They're continuing to add more products and services for their existing customers. And the more products that you get each customer to use, when you have a customer using 2 products or 3 products or 4 products, not only is the ARPU, the average revenue per user, going up, but that relationship is also much, much stickier. And, if you can, it's much cheaper to get a customer to add a new product than it is to go out and find a new customer. So, by getting customers to add additional products, to that relationship, it increases the margins for the company because the customer acquisition cost on those additional products should be essentially zero. So I think MoneyLion is doing a lot of the right things. I think both companies are actually doing a lot of the right things. But here's why I sold both. When we got that big pullback in February, the SPACs, meaning SBG and Fuse, were trading around 11, maybe, I think 11.50. So when you have, and because these SPACs come out at $10 is sort of the NAV, net asset value floor. So even though they could trade below $10, I mean, you really don't see them trade under like $9.90 a share. But then as they get closer to the merger, you'd see them come back up to 10 because you can redeem those shares at $10. So you really can't lose money under $10. So that's why $10 is the floor. So when we got that big pullback in small cap growth, and both of those SPACs were, let's just call it $11, and they traded back down to 10, a lot of the other small cap growth stocks that I owned were down 25 or 30%. So I sold SBG and Fuse because I knew that at some point we would get a bounce in some of those small cap growth stocks. And when we got a bounce, I knew that we would get a bigger bounce from the higher beta stocks like Futu and Upstart and Mohawk, and that we wouldn't get much of a bounce in SBG or Fuse. So I still believe in those two SPACs, those two companies long term, but I had to make a short-term capital allocation decision to sell both of them and take that cash and add to my other stocks, which had just pulled back 2, 3, 4 times more than they did. So it wasn't a knock on the companies. It wasn't any change in the fundamentals or the story or my outlook or any of that stuff. It was just a pure capital allocation decision in my portfolio. I still think SBG and Fuse could be 5-baggers over the next 5 years. So once again, I mean, I know I've repeated this a few times and I try to put it in every newsletter to remind people, I'm looking for stocks under 10 billion market cap that can 5x over the next 5 years. So every stock that I've written about this year so far, in December when I started the newsletter, I still believe they could be potential 5-baggers over the next 5 years. Now, I think some have a higher likelihood of getting there, and those are the stocks that are in my portfolio still and bigger weightings in my portfolio, like Futu and Upstart and Mohawk and DermTech and ClearPoint. So those are the ones I still have the highest conviction in, but there are other stocks that I've sold that I still think have a chance to do that. And, Stick would be one of them, and Inspire Sleep would be another, ticker symbol INSP. which does the minimally invasive sleep apnea, so that when you go to sleep, so if you have sleep apnea, you don't have to wear a CPAP machine. You can use this device that gets implanted on your chest wall and helps you, actually moves your tongue out of the way in the middle of the night to help you breathe so that you don't feel like you're suffocating. Amazing technology. And then other stocks that I wrote about recently that I sold would be Bandwidth, BAND, SBG, which is Owlet, Fuse, which is Money Lion. I still track these stocks all the time. I still like them long term. I just got out of them in the short term for different reasons, either because they only pulled back 10% and I wanted to move the money to something else, or I got out of Bandwidth because it just felt like all cloud stocks and technology stocks were getting hammered in the first couple months of the year. And even though I felt it was unfair to Bandwidth, because Bandwidth was already trading at a much cheaper or lower price to sales multiple than Twilio, which is kind of their larger competitor, Bandwidth was still selling off, and it was just brutal to watch. So at some point, I just had to cut my losses, get out of the position, and move that money into something else. It doesn't mean that my thesis on Bandwidth has changed at all. The company's still growing revenues at in the 30s. And the price to sales is probably somewhere in the high single digits. So I still think it's a very compelling investment story. So the two most controversial sells probably recently for me. And let me preface this by saying these are stocks I sold because I wanted to take a tax loss with the intention of getting back in after the wash sale rule was over. So for anyone who doesn't know, so there's a rule out there that you can take a tax loss. You can sell a stock that you have an unrealized loss on, take that loss, use that loss to offset your gains, but you can't buy that stock back until the 31st day. I say 31 days. So two stocks that I still love, love long-term, but sold in the short term to take the tax loss, wait 31 days, and then get back in would be Transmedics and AppHarvest. So I could spend an hour talking about both companies and why I still like them. So I'll cut it down to probably a minute each. Still two of my favorite stocks out there. They're on my screen. I watch them every single day. Both of them have gotten beaten up pretty bad recently. So Transmedics went in front of the FDA panel 3 weeks ago for approval on OCS Heart. Now, this is OCS Heart for DBD, which stands for donation after brain death. OCS Heart for DCD, which is donation after circulatory death, doesn't happen until next year. And that's actually a bigger catalyst with a bigger market opportunity than DBD. And I don't know if enough people really understand that. We also have OCS liver coming up. But the FDA panel was eye-opening. I don't think a lot of us have, including me, have really sat through an entire 8 or 9 hour, maybe even 10 hours FDA panel hearing. The company gets up and speaks. The CEO did his presentation for maybe an hour, and then the FDA gets up and gives their presentation, and theirs was twice as long. It was like 200 slides, and it was tough to watch. I mean, they really did poke a lot of holes into the Transmedics product and the data and the trials. And as I'm watching it, I'm thinking, this is really frustrating. Like, it just seemed the company didn't do a great job of talking to the FDA, several years ago and designing a trial that the FDA would have been more comfortable with. So perhaps the company screwed up and they just, they rushed the trial. Either way, common sense, I'm thinking, but still, how do you even compare Transmedics OCS Heart against the traditional way of doing it, which is cold storage, which is just a fancy way to say we're going to transport your organ in an ice cooler and hope that it's not dead by the time it gets to the recipient patient. So, it sucks because you find this company and you get so excited about their technology and what they could do for, tens of thousands of people every year in terms of preserving or even saving more organs for transplant and transporting these organs farther than 2 hours. The problem is that once you start to transport an organ in cold storage over 2 hours, that organ starts to die. And then once you get past 3 hours and 4 hours, the likelihood of that organ still being usable is under 30%. And Transmedics, with their machines, their OCS machines, which stands for Organ Care System, has a chance to change that and take down these distance barriers so that you can actually match up donors and recipients from different parts of the country. And you can, I mean, literally get these OCS machines or units onto an airplane and fly them across the country and save someone's life. And it's hard not to get excited about that. I think the challenge that I run into now, and I'm more aware of this, is you can fall in love with a story, but you have to be more disciplined on valuation. And I think that's where I screwed up this year. Was I fell in love, and I think I think Transmedics and AppHarvest are different in this regard, because Transmedics had more catalysts on the horizon, meaning the FDA panel and then the FDA decision. And even though the panel voted in a positive way, so if anyone actually sat there and watched it, I did. It was like gut-wrenchingly stressful, but you saw the vote come back. They had all the numbers on a piece of paper that they showed on the screen. So you could see that, it wasn't an overwhelming, well, one of them was there was three questions on there that the panelists had to vote on, yes or no. And the first one was pretty close, but it was still in favor of, OCS heart getting approved. 2 and 3 were even more positive in terms of like yeses versus nos. It was even more skewed towards yeses. So I was feeling really, really good. But then you get to the panelists. They get an opportunity to all speak, and they have to say what they vote, whether they voted yes or no or abstained. And then they had to talk, their reason as to why they voted yes or no. And that's where everything got screwed up, because even though some of the panelists voted yes, they still had some negative comments to say about, the efficacy and the potential safety and the lack of long-term data and the lack of a clear trial, I guess, that the FDA was comfortable with. So, and then of course the no's really beat up Transmedics for their trial and not doing more animal testing and some other stuff. So, and it sounded like a lot of the panelists, whether they were yes or no, really only wanted the Transmedics machine to be used for hearts that had to be transported over 4 hours. And the difference between the problem there is, yes, a lot of organs get transported over 4 hours, but there's also a lot that don't. And if you can only use it for organs that get transported over 4 hours and not the ones that get transported less than 4 hours, then you're obviously shrinking the size of the TAM, the total addressable market. And that's why the stock sold off over the next few days, even though it opened or pre-market the next morning. I think it was up 12 or 15%. And then as soon as the market opened, it got down into the red, and then it sold off 20 or 25% over the next few days. And I made the decision because a lot of stocks were selling off at that point. It wasn't just Transmedics. I said to myself, okay, I still love this company long-term. This is still a stock that I want to be in for the next 3 to 5 years, because I still believe that OCS is better than cold storage. And I believe that Transmedics can help save a lot of lives with their organ care systems. But we're probably not going to get the FDA decision for 2 to 3 months, which means this stock probably goes sideways for the next couple months, since there's really there's no reason, until we get to the FDA decision, there's really no catalyst that are going to move the stock higher. So I thought, okay, I have a loss in the stock right now. I already took some gains this year in Upstart and Futu and a few others. This is a chance to sell Transmedics, take the loss, and then I can get back into the stock in 31 days and have a position in the stock before we get to the FDA decision. So that's why I sold Transmedics. It wasn't because I don't believe in the story anymore. It was a tax loss decision with the ability to take a tax loss and then still get back in before we get to the FDA decision. So my conviction in Transmedics has not changed at all. And like I said, there are other catalysts coming in the future, which is going to be OCS liver and OCS for DCD. The other one that I sold recently for, once again, to take a tax loss, this was another write-up, was App Harvest. So for anyone that isn't familiar, App Harvest has created these indoor vertical farms, and the first one that they built is down in Moorhead, Kentucky. It's 2.8 million square feet, and for anyone that doesn't really understand, this industry, and I didn't really understand it until I dug into the company. I don't think we appreciate how inefficient outdoor open field farming is. Not only because you have, the weather elements, but then you have all the insects, which requires more pesticides. There are a lot of reasons why open field farming just doesn't make sense compared to indoor vertical farming. And the number that always stood out to me in my research was App Harvest has a 30 times better yield per acre than outdoor open field farming. And they're able to do that because they can grow indoors 365 days a year in the perfect conditions. They don't have to use any pesticides. They used recycled rainwater as their water source, which means they use 90% less water than outdoor open field farming. And then recently, they bought a company called Root AI out of Boston that has these literally robots. It's a robotics company. It's an AI and robotics company. So the AI helps the robots identify the produce and determine if it's ready to be picked or not by the color or the shade of the vegetable in this case. So, when we talk about App Harvest, it's not just a farming company. I mean, it's turning into a tech-enabled, vertical farming company with insane yields. And it's one of these companies that, I mean, they are doing great things for, our food supply, humanity, the planet, all of that stuff. So it's a heartwarming story. It's a company that's easy to, get excited about and passionate about, which I am. It's also not great that we're importing 50% of our produce from outside of the US, where, not only are they wasting a lot of expenses on transportation costs, but God knows what kinds of pesticides or chemicals they are using in Mexico, as they're growing these tomatoes and, fruits and whatnot outdoors. So, the fact that App Harvest doesn't have to use pesticides because they actually, for anyone who didn't read my write-up, I mean, there's other cool stuff in there. Like they actually have they actually use insects to control the insect population, and they actually bring in beehives and use bees to pollinate the vegetables. So, I mean, they're still doing that's low tech stuff, but I mean, they really are. It's in an effort to create the optimal growing environment. And then the exciting part is the company has plans to build 12 to 15 more of these massive structures over the next 5 to 6 years. So they already have 2 more under construction in Kentucky, and then they think the next 3 or 4 after that might still be in the Kentucky area, or they might go up into New England or go out towards the West Coast. But it does sound like they really love Kentucky because, labor is available, labor is cheap, land is cheap. And there's really it used to be coal country, that's where they had a lot of coal mines. So the area has been decimated. So there's a lot of people out of work, and they're able to, contribute a lot to the local economy and the local communities. They're actually a certified B Corp, which is just a really high threshold in terms of ESG. And so that's another part of my thesis is I think all these ESG funds and these foundations and nonprofits that want to invest in ESG companies, I thought that's where App Harvest could benefit as well, by attracting this ESG money. I think the part that like I said earlier, 10 minutes ago, that I got lost on or distracted by was I fell in love with the company, and I fell in love with the story and the mission, and I didn't pay enough attention to the valuation, and I chased the company higher. And then we got this big sell-off recently in SPACs because App Harvest was a SPAC just a few months ago. The stock price got absolutely, got crushed pretty hard. Now, I still love the company long-term, so I'm still planning to get back into the stock, but I did sell it a couple of weeks ago to take the tax loss, and then I'll get back in call somewhere around 31 days. And then hopefully, I can be involved with the company as the stock starts to, recover these losses. So, and that's going to happen. I mean, I shouldn't even have to apologize for it. Nobody should feel married to their stocks. These are investments. Now, I get it's sometimes you get emotional about these companies and what they're doing, or you just get emotional about your gain or your loss. Try not to do that. And I'll try too. I mean, I get sucked up in that stuff as much as anybody. I think the other challenge for me is because I've had a chance to interview a lot of these CEOs, that sort of adds another personal factor, I suppose, right? And that's why I think the people that short these companies are scumbags, because they don't care about the companies, they don't care about the employees, the products, the customers. These hedge funds that are shorting these companies are they only care about making money. And I'm not saying making money is a bad thing, but I think there's enough companies out there that I can make money being long, right, on the right side of these companies, and make money as they grow and increase revenues and whatnot. I'd rather be long these companies than betting against them. I mean, I don't know. I would just feel like such a scumbag shorting Transmedics or shorting DermTech. I mean, DermTech is, trying to revolutionize dermatology and give people a way to, detect skin cancer earlier and save lives. I can't imagine betting against that. Transmedics is trying to save lives with their organ care systems. I can't imagine betting against that. It's just something really scummy about that, in my opinion. I mean, I can't do anything about it. I think a lot of us have agreed or noticed over the last month that these small cap growth stocks have been under attack from the hedge funds. So the hedge fund industry is about $6 trillion, and they have access to leverage if they want it. And most of them are leveraged up, and most of them are doing some shorting. There's a lot of funds out there. They call it 130-30. So they're 130% long and 30% short. So a lot of these hedge funds are shorting stocks. And unfortunately, I think some of them have realized that you can put a lot of pressure on these smaller cap companies, especially the ones that have high retail investor ownership, because those retail investors, not only do they panic quickly, but they also have limited capital. I mean, retail investors tend to stay pretty fully invested. It's not like they have massive cash flows or inflows. So as their stocks are falling, they just don't have the capital to keep going in there and buying more, which obviously the large funds and institutions do. So, if these hedge funds identify these small caps with high retail ownership, they can start shorting these companies and start to shake out the retail investors, which obviously is just going to lead to the stock falling in price. And as the stock falls in price, it's going to shake out more retail investors and more. And then it just becomes kind of, this self-fulfilling prophecy. And then what these hedge funds do is, after they've pounded these small cap stocks into the ground, and the stock prices have gone down 30, 40, 50, 60%, which we've seen in a lot of companies over the last month and a half, then they start buying call options. So this is how they play the game, for anyone who doesn't know. Let's say a stock is trading at $50. Them and their buddies can start shorting the stock. Some of them are borrowing the shares like they're supposed to. Some are doing naked shorting, which is technically illegal, but they still get away with it. They keep shorting that stock, putting the pressure on. Retail investors are running out, panicking, selling. Stock drops from 50 to 20. Then the fund managers can buy some call options, some 25 calls, some 30, some 35 calls, and then cover the short positions to take the pressure off. And what do you know? The stock bounces. So not only do they make money on the way down by shorting it, now they own call options to make money on the bounce higher. So that's what we saw yesterday in the markets. Was hopefully, 2 days ago looked like some pretty bad capitulation. And then yesterday we saw, a pretty big green day. A lot of stocks were up 5, 10, 15%. I mean, there were some small cap stocks like Skills, which was down, I think, 65% from the highs, and Skills was up 30% yesterday. I'm pretty sure that 30% move yesterday was not buying or like traditional buying from funds or individuals. It was a lot of short covering as well. Because when you start to see those big violent moves higher, the shorts get scared, especially if they have a profit on that position. they don't want to see that position, that gain disappear on them. And that's one reason I think that this rally that we saw yesterday and we started to see today until the Biden made that announcement on the cap gains tax, which kind of sent a shock or ripple through the market. I think this rally could continue because a lot of these shorts are not going to want to stay short going into earnings. If you've been short a stock from 50 all the way down to 20, you've made a really nice profit on that position. It's not worth staying short going into earnings, because when a stock falls that much, expectations obviously come down as well. And that's when you start to see these companies come out with, even a decently strong number can, send that stock, 15, 20% higher pretty quickly. And then of course, we're going to start to get some guidance from these companies. So, because the pandemic was still going on when these companies reported Q4 numbers, which was March or April in most cases, maybe February, March in most cases. But like the vaccine rollout was still happening. So a lot of companies were not giving full year guidance on 2021. And they were sort of kicking the can down the road and saying that we would get guidance when they reported Q1 numbers. So I think over the next month or so, as we get some of these Q1 numbers coming in, we're going to start to get some 2021 guidance with it. And I don't think a lot of the shorts that have made 30, 40, 50% on these positions over the last 6 weeks are going to want to stay short on those positions going into earnings. So that's just my thought here, that I don't think this bounce rally is over right now. I think it could go on in small caps for the next couple of weeks. I also think that you could see a rotation out of large cap and even value stocks into some of the growth names. These hedge funds, like I said, they're not married to their stocks. They're only trying to make money. And, if you were shorting small cap growth and you were long large cap value or the recovery stocks over the past month and a half, you've done really well because you've made money on both sides. And now what you might want to do is start to trim back your positions in the recovery stocks, which have probably gotten overextended, and start to allocate that capital into the growth stocks, which are down 30, 40, 50% in some cases. So, I think a lot of the smart money is going to play that trade now. We're going to see money rotate out of large cap and into small cap. Similarly, that's sort of what we saw in, the fourth quarter of last year and early this year. We saw money rotating out of large cap into small cap. So I think we might start to see that again, just because of how, the separation and how they've traded over the last 6 to 8 weeks. Let's see. So hundreds of questions came in. I can't go through them all. I'm happy to do another webinar like this next week and try to answer more of the questions. I think what I'm also going to try to do is once a month, I will do, I'll do one of these webcasts, and I can sort of talk through some of my recent write-ups and whether I'm still bullish or, more bullish, 2, 3, 4 weeks after I did my write-up. Because I think it is, if I'm going to do these write-ups, I think it is helpful to have some follow-ups on them. If I did a write-up on a company in January, now it's April, how do I still feel about that company? Am I still as bullish as I was back then? Do I still think it has the potential to be a 5-bagger? Have the fundamentals changed? That sort of thing. So I think, feel free to shoot me a message on Twitter and let me know if you think that'd be helpful or not, but I'm happy to do it. INTZ. So for anyone that is a paid subscriber, you got this write-up last Tuesday. For anyone that's a free subscriber, you have not gotten the write-up yet. And let me explain why. So about a month ago, someone DM'd me on Twitter and said, hey, I know you're looking for a small cap cybersecurity company. Have you ever heard of Intrusion? And I said, no, honestly, I haven't. So I looked it up and I got pretty intrigued because there's a shift in the story. And I don't know if anyone was really paying attention to it, in terms of the big funds. So Intrusion was started 30 plus years ago by a guy named Ward Paxton. And the company was primarily doing, over the last 3 decades, cybersecurity work for DoD, which is Department of Defense. And then when Ward Paxton died, the company had an interim CEO for about a year. And then the company brought in this guy, Jack Blunt, who was a veteran of the industry, been around for 40 plus years in the tech industry and cybersecurity. The short report kind of, called him a turnaround specialist. I don't think that's a bad thing. And we'll get to the short report in a second. But so the story is interesting. They had two main products, one called Savant, one called TraceCop. And they had 30 years of all of this data. And what Jack decided to do was take those two products and package everything up into this new product called Shield. And Shield is essentially, they call it an AI-powered, or machine learning cybersecurity system for enterprise customers. And it sounds good, like the short report that came out the next day. So here's kind of the timeline, which is weird. I started working my write-up a couple weeks ago. Last Tuesday morning, the company sent out a press release that they had 50,000 plus seats on Shield. And then they announced a couple hires and a few other things. And then Tuesday afternoon, just a few hours later, I sent out my write-up on Intrusion. And I was feeling pretty good because no one else was really talking about this stock. Small cap company, huge growth potential, this new product that was already starting to, gain traction within enterprise customers. They had just announced, part of that press release was an announcement that part of those 50,000 seats were going to Kimberly-Clark, which is at least a Fortune 500 company, if not a Fortune 100 company. And, if you're Kimberly-Clark, you are not signing a multi-year contract and using a cybersecurity product that's going to plug into your network and rolling it out to thousands of your employees, unless you've done some significant due diligence and beta testing. And I don't think the people at Kimberly-Clark are dumb. So when management and the analyst and the investor relations person tells me that Kimberly-Clark did significant due diligence on the product, I have to take him at their word. So if that's the case, and Kimberly-Clark did all of that and then signed up for a multi-year contract for thousands and thousands of their employees at somewhere around $20 a seat per month, like that gave me a pretty good reason to be bullish on the stock. So, so here's kind of how it breaks down. The company's going to keep doing their DoD work, which is around $8 million of revenue per year. And then Shield is going to be, the upside from there. So if the number that they put out, last Tuesday morning is accurate, and there's really 50,000 seats on Shield. Now, to be honest, not all of them are activated yet. So, but they said they have 50,000 seats agreed to under contract with enterprise customers, but it could take them a couple months to get all of those seats activated. But that's kind of that's not really that big of an issue. That's probably pretty common for these big contracts. But that 50,000 seats by itself works out to about $12 million of revenue per year. And then the company on their Q4 earnings call, which was just a couple months ago, and I would suggest anyone that is interested in Intrusion, whether you own the stock or don't, you should listen to the Q4 earnings call. It is in the write-up that I sent out to all the paid subscribers last Tuesday, because Jack, the CEO, he talks more bullish about Shield than I've probably ever heard any CEO talk before about any product on any other earnings call. So his words exactly, or pretty close to exactly, were, in my 42 years of, selling technology products, I have never seen a pipeline, get this big, this fast on any other product. And he said that they have multiple beta tests going on right now with Fortune 500 companies and beta tests going on with at least 2 Fortune 100 companies that could result in at least 50,000 seats each. So, it's like you start adding up all of these pieces to the story, and it sounds great. And, I talked to investor relations twice last week, once again this week. I talked to Scott Buck, who's the analyst from H.C. Wainwright, who covers the stock. His numbers this year, his revenue projections for 2021 are 25 million. The revenue projections for next year from Scott are 50 million. He says that management has told him that they think that they can do 30 million this year and 60 million next year. So, but then the short report comes out Wednesday morning and kind of, throws cold water all over, my write-up and, my investment thesis. And the stock sold off pretty dramatically over the next couple of days, and it's rebounded a little bit over the last couple of days, or it was up 8 or 9% this morning until Biden's cap gains thing. But there's still reasons to be bullish on the story, because the short report, everything that was in the short report can kind of be like if you these short reports. So like personally, I think the guys that put out the short reports are scumbags. And let me just say this, you're only putting out a short report to make money. That's it. You are not wasting your time doing the research to put out a short report if you're not going to make money off of it. And there's two ways you make money, or two ways that I know of that you make money. One, your firm is short the stock and or owns put options on the stock. So therefore you are betting the stock is going to go down in value. So you're making money by the stock tanking. That's one reason that you would write a short report. Number two, you're being paid by someone else who is short the stock or owns put options on the stock. And they're betting that your short report can tank the stock so they can make money on it. That's why. Other than that, I don't know why any firm would put out a short report. So they're doing it to make money, bottom line. Now, obviously, I would like to think that they wouldn't put out a short report if they didn't actually believe what they were writing. But if you read these short reports, I mean, the crap that they put in there, they are twisting. If you actually know the facts and the truths, then you realize how much they're actually twisting things around. So the short report said that the Paxton family was dumping their shares, which is true. No, it's not even true. They're selling some of their shares in an organized, scheduled way. The Paxton family, the father died. The patriarch of the family died. So all the family members inherited his stock. They no longer have any connection to this company. No one else from the family works there. So why would they want to keep all of their shares? So the fact that they're selling in a scheduled way, SEC, I mean, you can go and read the SEC filings. That is not a red flag. I mean, that would be common for any family to do after the father passed away and they inherited all this stock. So, but of course, the short report doesn't tell you that. The short report also said that I forget the Michael Paxton. I think it's Michael Paxton. He was the CFO for a little while. I think it was either before, I think he was the CFO there for a while. But when Jack Blunt came in, he decided to resign. And I mean, you can speculate why, maybe he just didn't want to work for another CEO. Maybe he knew that the company was going to be launching these new products and getting into, enterprise sales. And maybe he just didn't feel comfortable, sticking around and doing the books because he didn't really understand that part of the business. I don't know. But, I don't see the short report said that Michael Paxton said he resigned because he was scared to death. And I just don't think there's any way. IR said that, okay, and they quoted the IR guy, this guy Joel, as the one that Michael said that to. And I asked Joel bluntly, like, did Michael say to you he was scared to death? And he's like, I don't even remember. Like, if he did, it wasn't because he was actually worried about the company. He was just scared to death of doing the job wrong, because he really was never a true CFO to begin with. This was a family-run business until the father died. And once the father died, the family members just didn't want to be in the business anymore. So it just pisses me off that these short reports try to manipulate the truth and scare investors out of these stocks until they can find out the truths for themselves. So the company Intrusion did put out a statement today. It wasn't the strongest statement that I've ever seen a company put out before, but at least they did, it was a rebuttal to a lot of the points that were in the short report about the company not having patents filed and not having certifications. And the statement today said that they do have patents issued on Savant and TraceCop, and they have patents filed as of last year on Shield. And I can attest firsthand that the USPTO, which is the US Patent and Trademark Office, is running very, very slow. I filed a patent last March, and we still haven't even gotten our first reply from the USPTO office. It's been 13 months, and we're still waiting for them to even start reviewing my patent application. So I'm not surprised that the company hasn't heard anything back yet from the USPTO office, but they said that the patents on Shield were filed. They also say that they have all of the certifications necessary to sell in every jurisdiction in the US and every jurisdiction outside of the US that they are currently trying to sell in. So, that's in writing on the website if you want to go look at it. Once again, I'm going to take the company's word for it. I don't think that they would put out a statement like that if anything in there was factually inaccurate. So, sometimes as an investor, especially small caps, where you only have two analysts that are covering a company, I mean, you have to rely on management being truthful with you, the employees that you talk to being truthful, the customers, and of course, investor relations. And if those people are going to lie to you, it's kind of hard to catch them. So that you do have to trust them at some point. And of course, if they are lying to you, then they can be, held. They can be criminally held responsible for that. So, and these CEO, these people in investor relations knows that. These CEOs know that. As someone pointed out on my Twitter feed today, I don't think Jack Blunt was coming out of retirement to run this company and commit any sort of fraud. So, if he's on earnings calls saying that this is the best pipeline he's seen in 42 years and that they have 2 Fortune 100 companies doing beta testing, I don't think he's lying about that. I think he's probably being very, very truthful, because I do think Shield is a valuable product for enterprise customers looking to protect their network and detect this malicious activity as quickly as possible and neutralize it. And something else that the short report said was that remote workers would not be covered by Shield. And investor relations said that is blatantly not true, that remote workers will be covered by Shield as long as they use a VPN. So, and I think most remote workers or employees for large companies are using a VPN if they're working from home. So they would be covered by Shield. So I have not sold any of my Intrusion shares in the last week since the short report came out. It's a decent sized position. It's a 7% position in my portfolio right now, and I'm pretty comfortable with it. I guess I wish the statement today from management had been a little bit stronger, but I mean they sort of rebutted what they had to. They covered their bases. And I think now, it's possible that they weren't stronger in their statement because they want the numbers to speak for themselves. And, when they report Q1 numbers and then they, talk about how many seats they have on Shield and, how many customers they have doing beta testing and, whatever other facts they can come up with, that's the sort of news that's going to move this stock higher. So, I like to say that markets are efficient, but not in the short term. So in the short term, especially with small cap stocks, there is a lot of noise that can move these stocks around. But in the end, it's the fundamentals that move these stocks higher. So whether it's short reports or whether it's, 50 other things that can move these stocks tomorrow, the next day, next week, next month, if you're a long-term investor and you want to own these companies for the next 3 to 5 years, then you have to wait for these fundamentals and the catalysts to play out. And if they do, then these stock prices go much higher, and whatever short report, came out in April will be meaningless 3 years from now. I mean, there are short reports that came out on Shopify, Peloton, Celsius, and each one of those stocks is anywhere from 5 to 10 times higher now than when that short report came out. And most of these short reports are absolutely freaking ridiculous. Like they say, the stock has 80% downside. And so it's a $10 stock now, and they're saying it has 80% downside, like it's going to $2 based on what? So I mean, these short reports, they just pull numbers out of their ass. So some of these questions. What is a good strategy for trimming your portfolio? So I mean, this is different for everybody. I trim when I think stocks are getting too far extended off of the, 10-day or 20-day moving average. A lot of these stocks were doing that in February. Shame on me for not being a little bit more disciplined and selling, trimming those stocks back because of because of the run that they had. Now, because I had more stocks in my portfolio in February, none of them were over 10% in my portfolio. So I would not have been trimming them based on position size. I would have been trimming them just based on how much of a run they had, over the first 6 to 8 weeks in the year. But by trimming them, you are creating a short-term capital gain. So you have to pay taxes on that. And then you're sort of hoping the stock pulls back so that you can buy it cheaper. But what if it doesn't pull back? Or what if it only pulls back a little bit and then starts to rip higher again? Then you regret trimming the stock. So, even though trimming is a strategy that sometimes works, sometimes it backfires too. For growth stocks that are included in your write-ups, do you recommend holding for a certain period of time? Yeah, this is really different for everybody. I still own Upstart, Dermatech, Mohawk, Celsius, Futu, ClearPoint, Intrusion, Audio Eye. Those are all the ones that I still own that I've done write-ups on. So I still have a few other stocks in there that I haven't done write-ups on. But, let's see, we are in April 12, 15. Maybe I've done like 15 or 18 write-ups in total. I don't have the exact number in front of me. So I probably still own at least, I own at least half of the stocks that I've done write-ups on, maybe even more than that. So, and like I said, I sold Transmedics and App Harvest for the tax loss, and I'll get back in. I sold Owlet and Money Lion because they pulled back less than everything else. And that was a capital allocation decision. So once they de-SPAC, right? So once those mergers are complete and they start trading under their real ticker symbol, then I will most likely get back into both of them because I do like both of those stocks long-term for all of the reasons that I outlined in those write-ups. Is growth stocks a casino? No. Casino is really just based on luck, maybe a little bit of skill. I think if you're going to invest in growth stocks, there's still some, there's definitely some skill to it, research, education on the industry. There's a lot of due diligence that goes into, deciding when to or when not to take a position in these companies. I think with growth stocks, you need to understand the volatility. As I said yesterday on Twitter, everybody wants the big returns without the big pullbacks. And unfortunately, you typically can't have the big returns without the big pullbacks. Go look at Amazon, go look at Netflix, go look at NVIDIA, go look at Exact Sciences. Those stocks had massive runs over the last 10, 15 years. They also had massive pullbacks. I think each one of them pulled back by at least 50, 60% at one time. And some of them pulled back 30, 40, 50% multiple times. So, some people are good enough to manage that volatility better and know when to get out and when to get back in. And if you have the talent to get out at the top and then get back in at the bottom, then you should be running your own hedge fund. Very, very few people have that talent. And if you do, doing it on a larger scale with more capital is 10 times harder than doing it in your personal account. Using that strategy of trading around the volatility and getting out at the top and getting back in at the bottom, it's a lot easier to do it with a individual account, a couple $100,000 than it is doing it in a $2 billion institutional fund. So that's why most investors that invest in these small cap growth stocks are in them for the long term, and they're just willing to absorb those pullbacks, knowing that it's just part of the process. If you want to find those 10, 15, 20 baggers, you can't worry about a couple 30% pullbacks along the way. So, but that's why it's good to have some cash available so that you can add on those pullbacks. Stocks don't go, straight up forever. You're going to get some pullbacks along the way. So try to have some cash available so that you can add to them. DNMR. So this is Danimer Scientific. I haven't done a write-up on it. It is a stock that I did own back when these stocks were ripping in the first 8 weeks of the year. And then, because this is a recent SPAC, another high growth, high multiple SPAC, the stock has gotten punished pretty badly over the last 6 to 8 weeks. I did sell it a few weeks ago to take the tax loss. And to be honest, if when that 31-day wash sale rule is over, if the stock is still trading where it is today, which is around low 20s, there's a really good chance I get back into the company. So, essentially in a nutshell, the company makes a biodegradable plastic, and they already have partnerships with companies like Pepsi and Mars Candy. So if anyone has been following the the plastics problem that our world is facing, companies like Danimer are part of this solution. And those are the types of companies that I want to invest in and own for the next 3 to 5 years, because not only is there a lot of potential growth there, but they're also doing some great stuff for humanity and the planet. Do you think it looks bad if you interview a CEO of a company, send an email with all the reasons why you added it, and then a couple of weeks later you sell the stock? I mean, that's your opinion. I mean, you have the right to interpret that any way you want. Like I said, I'm not going to be married to my stocks. Nothing has to change with the fundamentals in the company for me to still sell it. And if I sell a company in that, even though the fundamentals haven't changed, if I'm still bullish on the company long term, I might still sell it, either one, to take a tax loss, or two, because I like my other stocks more, and that's just the reality. I mean, if you own 20 stocks in your portfolio, there's no way you like 20 stocks all the exact same. So if you have 20 stocks and, 2 of your favorite stocks are down 20% on no news, then you might want to sell 1 or 2 of your other lower conviction stocks to add to your higher conviction stocks that are down 20%. And that's where it comes down to, what sort of a price target do you have for these companies over the next 2 or 3 years, or even 3 to 6 months? I mean, sometimes when I'm moving money around in my account, it's because I'm moving money into the stocks that have had a recent run, and then taking some profits there and putting that cash into some stocks that I think will perform better over the next 3 to 6 months. So recently I sold 2 of my stocks. One is InMode, INMD, and one is Ozone, OZON. I still love both companies. I think they're phenomenal companies, but they both held up really, really well in the last 3 or 4 weeks. InMode is like, they were making all-time highs almost every single day, as most of my other stocks were pulling back. And Ozone, maybe was down 10% when some other stocks were down 30 or 40%. So in another capital allocation move, I sold Ozone and InMode and moved that cash into my other names, which had pulled back 30 or 40%, because I believe over the next 3 to 6 months, those stocks that have been punished the most over the last 4 to 6 weeks will outperform Ozone and InMode over the next 3 to 6 months. So that's how I move money around. That's why I sometimes have to sell a stock. But I also don't want to feel, just because I interview a CEO or do a write-up, I don't want to feel like I'm married to that stock forever and ever. That's not fair to me. So hedging in place, I don't have any hedging in place right now. I typically don't use much hedging. If I was going to, I would most likely buy put options on an index. So if I'm really heavily invested in small cap growth stocks, the index that is closest to my style would be the Russell 2000 growth. So the IWO, I could buy put options on the IWO, so that if my growth stocks tanked, those put options would provide some downside protection for me. What is shorting? Yeah, I mean, so it's essentially someone taking a bet against a company. They're betting that stock is going to fall, and they're going to make money the farther it falls. And the correct way, or the legal way to short, is you have to borrow the shares first. And there is some naked shorting going on out there. I'm not exactly sure who's doing it or how they get away with it, but it's definitely happening. There's also, there's there's a couple different metrics that you can look at for shorting. There's short interest and there's short volume. And a lot of times recently, you've seen short interest go up on stocks, over the last 6 to 8 weeks, maybe from 3 or 4% up to 20, 30%. But you've seen the short volume go up even more, which means that on a daily basis, there's more people shorting these stocks than buying them. So that's something that we have to be, mindful of and continue to watch. And, once again, I'll take some blame for not, appreciating the rising short interest levels and how much damage some of these large funds could do on these small cap stocks if they really started to overpower them on the short side. And I think, going forward, maybe I'll pay a little bit more attention to the short interest. But, like I've said a few times, I mean, it depends what kind of investor you are. Are you really trying to, time the tops and bottoms and get out at the tops and get back into the bottoms? Or are you really focused on the long term and you're willing to accept some of the short-term volatility and pullbacks, knowing that you trimmed a little bit at the top and that you have some cash available to add on those pullbacks? And I think I'm more of the second investor than the first. So not all Substacks that go out are equal. What are your 3 convictions for the next 3 years? That's a good question. So like I said, I mean, conviction can be interpreted a couple different ways. Is this, and I obviously I don't know who asked it, so I can't even ask you right now, but, so I guess there's 2 ways to answer it. One, which stocks do I think have the most upside over the next 3 years? And then which stocks do I think have the most upside with the least amount of downside risk, right? So there's like, pure upside is, I honestly, I think it could be someone like an Intrusion, because the stock's been beaten down so much the last week or so after the short report. If they really do add 50,000 seats on Shield in just the first few months, and they have some of these big deals coming through from Fortune 100 companies, I mean, honestly, this could be $100 stock in a couple of years, if not sooner. And so that's obviously massive upside. But there's the risk. There's the risk that that the short report was actually true. And, there are a lot of red flags at the company, and, some of what they're telling us is not true. Obviously, I don't think that, but there's always the chance that is the case. So like, even though Intrusion might have the most upside because of what Shield could become, I would never make Intrusion one of my top 3 or 4 positions because, of that potential risk. So, my top, I'm not going to give my exact like allocations or anything, but my highest conviction names that I feel the most comfortable owning, given what I think the downside risk might be or could be, worst case scenario, it's still Upstart, DermTech, Mohawk, Celsius, Futu, ClearPoint. Those are my top 6 names in no specific order. So I would say that those are my top. Well, you said top 3, but I gave you top 6. Those are my top 6. And then like another one. So Dario Health, ticker symbol DRIO, DRIO. I mean, that's another one. Like the more I look at it and the more I learn about the company, this could be the next Livongo. I mean, I know Livongo, what got acquired last summer by Teladoc for $18 billion. So like clearly Dario Health is not on Livongo's level yet. But Dario Health has spent the last few years really building a nice foundation ecosystem of products, mostly doing B2C, selling these products in retail. And now they're finally focusing on B2B, and then also getting insurance coverage to support it. So like, I just feel like Dario Health is one of these companies that's on the cusp of a really big move higher. Are you concerned about ZOA distribution? I don't even know what that is. ZOA? I have no idea. I'm going to Google it because I'm just curious. Oh, is that energy drink? Oh, is that oh yeah, I think that's the Rock. Yeah, fuck the Rock. I couldn't care. That's about it. I mean, is ZOA, or I don't know if that's how you pronounce it, are they going to get some distribution? Yeah, I'm sure. I mean, the Rock's got pull. Celsius already announced that they're in 82,000 stores as of the end of last year. I could easily see them get to 100,000 stores by the end of this year. They've already, they're in the process of switching from DTR to DSD. DTR is direct to retailer, which means that they're actually shipping to the retailer's distribution center, and then the distribution center has to ship it to the store, and then someone from the store has to stock the shelves. There's a lot of things that can go wrong in that logistics process. DSD, which is direct store delivery, means that Celsius is working with these DSD partners that bring the product directly to the store and stock the shelves themselves. And they're responsible for making sure that those shelves are always stocked. And that's a big difference. Typically you have to be, you gotta be one of the big boys to get DSD. And because Bang formed a partnership with Pepsi last year. So Pepsi bought Rockstar for $3.8 billion, which is a just horrible brand. I mean, Rockstar is a decaying brand, losing market share. Not that they really had a lot of market share, but Pepsi did a deal with Rockstar many years ago, and it was an exclusive deal. So Pepsi wanted to distribute any other energy drinks, they had to go out and buy Rockstar. Rockstar knew this. So they basically said, okay, if you want to buy us, it's going to be $3.8 billion, which was a ridiculous price to pay, but Pepsi paid it just to get out of the contract. So then Pepsi went to Bang and said, okay, we want to distribute Bang. Bang said, okay, fantastic. So then Bang turned around and said, screw you, to all of their DSD partners. So then all of those DSD partners were no longer able to distribute Bang. They came to Celsius and said, hey, we want to distribute we want to distribute your products into all of our stores that we work with. So, Pepsi and Bang coming together really opened up the door for Celsius to get these DSD partners on board much faster than it would have been able to happen otherwise. So Bang going to Pepsi was actually a really, really good thing for Celsius. So I'm not worried about the Rock or Zoa. I've never even had it. I mean, it might be a good drink, it might not, but I'm not worried about them. I mean, okay, let's be honest. The energy drink market is $60 billion a year right now, going to $100 billion in 5 to 6 years. It's growing at about 9% a year. Zoa and Celsius can do phenomenally well, both of them, without taking a single penny out of each other's pockets. They are not competing against each other. They are competing against Red Bull and Monster. So Celsius and Zoa, are not like, this is not a, one or the other. Both of them could be very successful and just take a little bit of market share away from Red Bull and Monster. How do you validate optimistically rosy projections that are displayed by SPACs? It's a good question. So if anyone hasn't paid attention or gone through some of these SPAC investor presentations, they do throw some pretty insane projections in there. And I don't really know who comes up with them. I don't really know how these companies are going to be held accountable, years down the road, whether or not those numbers actually pan out as they had projected. I also think it's ridiculous when these SPACs get announced, these mergers get announced, and they're like, yeah, we valued it at, 5 times, 2026 sales. Like, that is just ridiculous. Like, that shouldn't even be allowed to be said. If you've seen my write-ups on some of my recent SPACs, SBG, Fuse, Stick, oh God, I'm trying to remember. Maybe I have. I might list out what the revenue projections are going to be. But like when I talk about the valuation in the section valuation, I'm not using the numbers from 5 or 6 years into the future, because I just don't think you can trust those numbers. There's a million things that could go wrong between now and 2026 where those numbers might not even come close. So, I think just to be always better to skew conservative, I think, when you're looking at valuation on SPACs, and, use this year, use next year. I'd even, I'd throw caution about even using the year after that. In this case, 2023, and even when I'm typically doing valuations on companies, I'm typically using, current year and next year. A couple exceptions to that would be the stocks that are, on the cusp of hyper growth. So like DermTech, a lot of people have been throwing shade at me on Twitter saying, oh, how do you pay 45 times sales for DermTech? And it's like, how do you value a company that could grow revenues at 250% for the next 3 years? I mean, there is no, there really is no good valuation model for that. So I mean, you can do like a DCF, discounted cash flow model, and plug in all the numbers, and then you're sort of working back into what fair value is now, or what you should pay for that future growth and those future earnings. That's kind of how DCF works. But DermTech's a tricky one. I've done my own modeling and what I think the company can get to in revenues over the next 3 to 5 years. And that's using 6 million, which was last year's actual reported number for revenues. And then that is them getting up to 18 million this year. So 3xing revenues this year, and then 3xing revenues next year, and then 3xing revenues the year after. And then, then the growth starts to taper off. But, it's those first few years where you see these massive growth numbers, because they're coming off of such a small base to begin with, and then they're adding these new products. So like in the case of DermTech, right now it was PLA. Now, as of today, it's going to be PLA plus. But then later this year, you have Luminate, which is their UV skin analysis product. And then next year you have Carcinome, which is going to be a similar genomic smart patch, but for 2 other forms of skin cancer, not non-melanoma. So that's where you're going to see, PLA like this, and then Luminate, and then Carcinome, and then you could get 2, 3, 4 years of just massive hyper growth out of DermTech. So the question is, do you want to wait and see if that actually plays out, and then run the risk that you're chasing this stock higher, or are you willing to get in now before the hyper growth and be patient and wait for that story to unfold? And I'm in the second camp. I want to get in now when the stock is in the 30s and 40s, before we see that massive hyper growth, start to kick off. So, and the other thing that could happen, this is just pure speculation. Someone like an ARK Investments could obviously add DermTech to their genomics portfolio. And if that announcement came at any point in the near future, you could see DermTech up 15, 20, 25% very easily. I have no idea if that's going to happen. It could, it probably should. I mean, if they really are investing in these innovative, disruptive companies, I'm not sure why they wouldn't want a company like DermTech in their genomics portfolio or their genomics ETF, but we'll see. I mean, that'd be pretty cool if it happened. That'd be a nice win for current shareholders. Why the sudden stop in prices on growth stocks? I mean, there's a few reasons why. I mean, I think it started off with the 10-year treasury going up. As the 10-year treasury started to increase, it wasn't necessarily a concern about growth slowing down on these companies. It's more about as the risk-free rate of return is increasing, theoretically the multiple that you should be paying for the future earnings comes down. And that's kind of what happened. So that as the 10-year, essentially tripled from 0.5 to 1.5, you saw the contraction in multiples on growth stocks. But then, as that was happening, you also got a lot of these companies, doing secondary offerings as their stocks were hitting all-time highs. And then the shorts came in, and, the shorts sort of attacked these companies at the perfect time. If you're going to go after any company, but especially a small cap company with high retail ownership, do it, as the companies are doing secondary offerings, as retail investors are selling stock in order to pay their taxes. That's something that gets overlooked. As the brokerage firms are increasing their margin rates, which is taking away buying power. My broker, I think almost at least 2 or 3 times a week, I get an email from my broker, Interactive Brokers, saying that they're raising the margin requirements on this stock or that stock. And most of the time there's no reason as to why. I mean, I don't know why you need to raise the margin rates on, Mohawk or DermTech, but I'm just using those as an example. I don't even remember which. I usually just ignore them. But yeah, margin requirements have definitely been going up over the last 6 months on a lot of small cap stocks and SPACs. And what's stupid is they're doing them on SPACs that are already trading close to that net asset value. Like if the SPAC is already trading at $10, there's really no downside in the near term on that stock. So why would you have to increase the margin requirement on it? That really makes no sense to me. So it was kind of the perfect storm for shorts. You had, like I said, the 10-year going up, you had secondary offerings, you had some insiders selling, you had money moving out of growth into value or into the recovery stocks. And then you also have like this dead zone in between Q4 earnings and Q1 earnings where you really don't have any catalysts. So that's a good time for the hedge funds or the shorts to attack the small caps. Should I try to trade in and out and lock in profits? Yeah, I mean, I think I kind of covered that. I can't give specific advice to anybody. I mean, I just think generally speaking, it's pretty hard to time the perfect time to get out and when to get back in. So unless you're really, really good or you're watching your portfolio on a daily basis, if you're a long-term investor and this is, investing is sort of a side gig or a hobby for you, you really shouldn't be trying to time the ins and the outs like that. Do you have strong conviction in STPK, which is stem.com? I don't really know it well enough yet to say. I've done some due diligence and it does look like a pretty cool company in terms of energy storage, but I still need to learn more. Estimated timeline on the Jonah ETF. Yeah, okay. So I hope it happens, to be honest. I mean, it's definitely something that I'm still thinking about. I don't know if I could continue to do my Substack and my StockTwits while running an active ETF. So I've talked to a few different vendors. So if I actually wanted to do this, I could get the ball rolling pretty quickly. It's not cheap. It's about $50,000 up front to get it started and about $20,000 a month of operating expenses, not including any payroll. So if I hired a 5 or 6 person team, I'm looking at another, $400,000 a year in payroll, software, technology, insurance, all of that. You add it all up and you're at about $700,000-800,000 a year in total expenses. If I charged 70 basis points, so let's just say $750,000 divided by 0.007. So, I really need a little bit over $100 million of assets in order to break even. I think I can get to that, but so that's one risk. What if I don't get to the 100 million in assets? Then I'm actually losing money on the ETF. And that's not ideal. And then the other dilemma is whether or not I could continue doing my Substack and StockTwits, which I really love doing, whether I could keep doing that while I'm running the ETF, or I could, there's probably a way to get around it where I could separate them into 2 separate businesses. And, if you just have all the right disclosures in place and, strict trading, trading restrictions, meaning, if you mention a stock in a newsletter, I can't buy or sell it for 2 weeks or something, before or after, something like that. I mean, there's ways around it. So I think it'll probably happen, to be honest. I just don't know exactly when. If I had to guess, I would say probably sometime before the end of this year or maybe early next year. What kind of research and metrics should investors be creating? Whoa. Yeah, I mean, there's a lot of different things that you can look at when, I don't know if you mean in terms of valuing a company or not. I mean, there's the main ones that I typically look at for growth companies. Most of these companies are not profitable yet, so they're not going to have any earnings. So PE ratios is kind of irrelevant. And, if you're talking growth companies that are still in the early days, even if they are profitable, those earnings are going to be minuscule and you're going to be looking at PE multiples that are in the hundreds, and that can be sort of misleading. You can't compare a, $3 billion company growing at 80% a year to a, $80 billion company growing at 15% a year. You can't compare PE multiples one to the other because they're completely different businesses. One is much more mature. That $80 billion company is probably already profitable, slower growth. So you're not willing to pay as much on those earnings because it's coming with slower growth versus those hyper growth companies who are willing to pay more for that revenue growth, assuming that it's sustainable. So like when I'm looking at companies, it's really, it's gross margin, it's EBITDA margin, it's net income margin, it's free cash flow. And then of course, revenue growth. I mean, revenue growth is absolutely the first one I look at. So I would say, revenue growth is first, and then probably EBITDA margin is second, or gross margin. It depends on what kind of a business it is. I mean, if it's software, so like AudioEye, for instance, or like Intrusion, and then even some of the medical device companies, they're going to have gross margins in the 60s, 70s, and 80s versus other companies like, just look at my list, like Grow Generation. I mean, they're going to have gross margins in the mid 20s, Mohawk's in the mid 40s. DermTech is actually really low right now, but that's just because they don't have enough scale yet to bring up the gross margin. I think DermTech's gross margins are right around 30 right now, but I could see that getting up into the 60s or 70s in a couple of years. Celsius is probably in the mid 40s right now. Futu is very strong. Futu is around 80%. So, I mean, like that's why I say gross margin is important to look at, but it really depends on the industry. Like I've seen some people, there's a stock out there. What's a good example? I mean, you could even take Chewy. So like, let's compare Chewy to BarkBox. Chewy's not growing as fast as BarkBox, and Chewy's gross margin is around 20%, I believe, where BarkBox's gross margin is around 60%, because Chewy's selling other people's products, so they can only mark them up a little bit. BarkBox is creating and manufacturing their own products, which obviously has a higher gross margin. So, I mean, you could try to compare those companies because they're in the same industry, the pet industry, but the metrics are going to look completely different on both. So you should be willing to pay a higher price to sales multiple on BarkBox because they have higher growth and higher gross margins than you would pay on Chewy. But then Chewy might get a little bit of a premium because it's a more established brand, a more established business, probably closer to profitability, bigger customer base, et cetera. So it's hard. I mean, it really is company to company and industry to industry. I like DermTech as a core position. What's the most important metric to look at for the next investor call? Yeah, so DermTech, I mean, if you're looking for a big blowout number from DermTech for Q1, I wouldn't get your hopes up. I don't think we're going to get a big blowout number, partly because, Q1 numbers is, for most of these companies, was January, February, March, right? Q1. In a lot of regions of the country, this pandemic was still going on in Q1 as the vaccines were being rolled out. So, there were still a lot of restrictions in place for some of these companies. And, if you're a DermTech and you have salespeople trying to get out there and do demos for dermatologists face to face, it's a lot harder to do with some of the restrictions that were in place. So, I think companies, and then, I would even say companies like ClearPoint are sort of stuck in that as well. Companies like Upstart and Futu didn't have that problem because they're really, more software based, but companies, medical device companies that really require more face-to-face interaction with the doctors, I wouldn't expect big blowout numbers from them in Q1. But I think as we, get into the second half of the year, post-pandemic, vaccines are all out there. That's when you can start to see some of these numbers really, really jump out. So, but I mean, it's like in terms of the numbers, you want to see the revenue numbers. So I have a spreadsheet of all the stocks that I track. So hold on. So I have a spreadsheet that I'm going through right now of like 45 of my favorite stocks that I track. And then I have them split up into, so I have the Q1 earnings date, and then I have Q1 revenues estimates, year-over-year growth, and then the actual reported number, which is obviously a blank column right now until the companies report. And then I have 2021 revenue estimate, year-over-year growth, and then guidance, which obviously, most of these companies haven't given yet. And then I have a few more columns like gross margins, EBITDA, and net income. But on DermTech, so DermTech is, they're only expecting 2.1 million for Q1 Q1 revenues. and that would be 34.9% year-over-year growth. Full years estimates, consensus estimates right now on DermTech are 12.2 million, which would be 107% year-over-year growth. But then you start to look at 2022 and 2023, when you have the introduction of those other two products that I mentioned, Luminate and Carcinome, and that's when you start to see the 200, 300% revenue growth. So, you know, the DermTech story is still a good one, but it's still early. I mean, I think we're going to have to wait another 6, 12, 18 months to really see that hyper growth. The question is, how many people are willing to buy in now before the hyper growth kicks in versus how many want to wait to see if that hyper growth actually comes through, and then they're willing to buy in later and chase the stock higher. So let's see. Do you believe SPACs will come back the way they were in 2020? Probably not to that same degree. I mean, last year and even the beginning of this year, I mean, SPACs were announcing deals and popping 15, 20, 30, 40% in some cases. I don't think we're going to see those days anytime soon, unfortunately. I mean, it was kind of fun while it happened. I think we all made some easy money off of it. But probably not. You know, it's going to be a little bit harder for these SPACs, which, to be honest, I mean, for long-term investors, maybe that's a good thing. You know, if you have cash coming in every month, you know, now you don't have to chase these stocks as much as you did a couple months ago. So, you know, in some ways, these pullbacks can be healthy for long-term investors. It just means it's a little bit more painful in the short term on some of your positions. So I'll do like another 15 or 20 minutes of questions. I'll just keep going through some of these. I'm heavily invested in DM. What are your thoughts? So DM is Desktop Metal. So I was actually supposed to interview Rick Fulop, the CEO and founder, tomorrow, or actually today. But I talked to him yesterday with his investor relations guy, and they said, listen, can we postpone this until after we report Q1 earnings in May? Because we have a whole bunch of things that we're going to be announcing, and we want to be able to talk about them openly and freely. And I agreed, okay, let's wait. So I haven't really dug in yet on the DD for Desktop Metal. I really don't know the company that well. I really don't even know 3D printing that well. But over the next few weeks, I will start to dig into the company and the industry prior to my interview with Rick. And they actually invited me up to the Desktop Metal headquarters in Burlington, Mass, which is like an hour away from me. And so I might do the interview there and then also get a tour of the facility. And, you know, maybe we can take some pictures and do some video and stuff like that. So, so to answer your question, I really don't know Desktop Metal that well yet, but I mean, from what the little bit that I've read, it does seem like a really cool company that has a very bright future, but I can't really say yet if I'm going to own it in my portfolio, and I don't own it right now. Do you think it made sense for Intrusion not to comment? They did comment today, but when these questions came in yet, that report wasn't out yet. So the lawsuit, the lawsuits are so ridiculous. Every single time a short report goes out on a company, within 2 days, you're going to see a dozen different lawsuits from a dozen different shitty law firms. They are just trying to, you know, pick up some plaintiffs, I guess, right? Is that what it's called? Plaintiffs? Yeah. Grab some plaintiffs, throw them into a class action lawsuit, and then try to get a quick payoff or settlement from the company. 99% of these lawsuits go absolutely nowhere. I mean, not even just companies that get short reports put on them. I would say any stock that drops more than 15% in a day or over a 2-day period, you see these stupid lawsuits popping up all over the place. Like they're all over Twitter, they're in my DMs, like it's ridiculous. So they mean nothing to me, like less than nothing, to be honest. Yep. So I mean, I've answered a lot of these questions. Do I still think Transmedics can be a 5 or 10 bagger in the next 5 years? I do. 10 bagger, we'll see. 5 bagger, definitely, which is why I want to get back to the company, because I do think Transmedics is definitely the sort of company that can go 5x over the next 5 years. So I do want to own them after these 31 days are up. Since you're not posting your daily portfolio because of obvious reasons, will the subscribers still be notified? So like I said, opening up, I really can't do daily or even hourly notifications on my Substack. There's just too many people that don't care about that stuff. So if you want my daily buys and sells, and there's not a buy, I don't buy or sell every single day. I mean, I didn't do anything today, and I trimmed one stock today, and I didn't do anything yesterday. And then a few days ago, I did a lot of stuff. So like some days there's obviously more activity than others, but if you want that activity, you would have to join my StockTwits room. And StockTwits just announced a couple of days ago that they're in the process of rolling out real-time alerts. So I will be able to connect my Interactive Brokers account to my StockTwits account so that every time I buy or sell something, you get an alert. And I think some people like that idea. Are short sellers focusing on my stock picks? Yeah, some of them probably are, but I also think they're just focusing on small cap stocks that have high retail ownership. Why worry about this downturn? Yeah, I agree. I mean, if you believe in these stocks, I'm all blurry. There we go. If you believe in these companies and you want to own them for the next 3, 4, 5 years, then there's really no reason to panic sell any of them unless you're doing what I did, which is either reallocating capital to the higher conviction names in your portfolio, or you're taking tax losses in the short term with the intention of getting back into those companies in 31 days. Can we discuss new rules around shorting? I mean, there's rules there. They just don't always get followed. I mean, I think it comes down to these brokerage firms and what they're enforcing and what they allow. What is your advice on new traders with margin? So, I mean, you can blow yourself up with margin pretty quickly, depending on how much you're using. I use about 20%, or at least that's what I have right now in my account. Because I'm in small caps, I really couldn't go much higher than that anyways. So maybe that's a good thing. Margin, you're borrowing money from your broker in order to buy more stock. But if your portfolio declines, then you're declining by that much more. So if you're on 50% margin and your stocks go down 10%, you've technically lost 15%. So that 15% is coming right out of your capital. It's coming right out of your, what they call your net liquidation value. So if you're going to use margin, be very careful. You have to be more disciplined. If you're going to use more margin, I would definitely suggest, probably not for long-term investors that are more buy and hold. There's really not any reasons for them to use margin. If you're going to use margin, you really should be more active, and you're the kind of investor that is, that you are trying to trim the tops and add on the bottoms. Some nice comments. Thank you very much. Mohawk has gotten crushed recently. Can you talk about Mohawk? I mean, that was like the first stock I talked about this morning. So if you're on Twitter, I did share a video. I think it was either yesterday or this morning. It might have been this morning, actually. Like I said, one of my friends did a interview with Yaniv, who is the founder and CEO of Mohawk, and he actually did a screen share and did a walkthrough of Amy, which is their proprietary AI software. And he showed how Amy works in real time with, logistics and marketing and all sorts of financial stuff and pricing and ad buying and a bunch of other stuff. Like, it was actually kind of eye-opening. I hadn't seen it like that before. So I actually wonder if that's one of the reasons that the stock was up big this morning, is people started watching that video going, wow, there actually is something, pretty cool and unique here. So top 5 conviction stocks. Yeah, I mean, I just went through those. Portfolio sizing. Yeah, I mean, that's based on, my highest conviction names with the least amount of risk. So, Futu was my biggest position coming into the year. It ripped. I trimmed it back. DermTech became the biggest. And then it was Upstart. When Upstart went 3x in 3 days, then it became my biggest. And then I trimmed that back down. And then Futu went back to the top because then Futu pulled back to 100. So I doubled down on Futu. Futu got to 175 a couple days ago. So I trimmed that back down. And then announced a secondary offering. So then it dropped another 20%. So now Upstart is back at the top. DermTech is second. Mohawk is third. Celsius is fourth. And Futu is fifth. So, I mean, like those are clearly my favorite stocks, and they just keep moving around in the portfolio based on, how much they're running or dropping and what I'm adding to them or trimming back. So, but like in terms of position sizing, they're all pretty close. They're all within the top 5 positions are all within 5% of one another. So what goes through your mind when DermTech crashes or in any stock crashes 40%? Yeah. How do you keep your cool? So it's not easy. I mean, to be honest, like I don't panic very easily when it comes to stocks. I realize that if I'm correct, and DermTech really is a potential 10 bagger, 15 bagger, 20 bagger over the next 5 or 10 years, then 40% drop this month means absolutely nothing to me. I mean, yeah, do I want to beat myself up because I could have trimmed it a month and a half ago at 84 and then bought those shares back this week in the 30s? Yeah, of course. I mean, who wouldn't beat themselves up over that? But I mean, first of all, none of us knew that DermTech was going to drop 50%. None of us knew that the shorts were going to attack it as much as they have. So, I mean, if I had thought that DermTech would pull back 40, 50%, yeah, of course I would have been more aggressive with trimming. But, these are same with Mohawk. Mohawk's down 50% off the highs as well. I could have trimmed that more, but I didn't think in a million years Mohawk would be a $20 stock this week. So you just have to learn not to beat yourself up. You have to figure out what kind of investor you are. If you are a short-term trader, then shame on you for, not taking more profits in those stocks. But if you're a long-term investor that wants to reduce their tax liability, without getting beat up on short-term capital gains every year, then you have to be, you just have to focus on where you think these stocks can go in 2, 3, 4 years and, trim them when they get overextended and then hold on to that cash and wait for some pullbacks. Because if a stock goes up, 50% in a month or 60% a month, like DermTech did back in January, February, there's a 90% chance that stock is going to pull back for you. So, whether it pulls back 15%, 20%, 30, 40, 50%, that's a case by case situation. But I'm like, the money that's in my account right now, this is not money that I have to touch anytime soon. This is money that I'm probably not going to use for the next 15 or 20 years. There's money in here that I'll probably use on a house at some point. But other than that, most of it is really going towards retirement, or, I'll give some to my nieces and nephews for college, that sort of thing. So I'm just not really worried about what DermTech does today or tomorrow or next month. I mean, that's not why I own the stock. Short reports have been bringing down stocks. Often companies try to refute them with a press release. So one more thing with intrusion. I forget if I mentioned this before or not. They in investor relations said that I can interview the CEO after they report Q1 earnings. So, which is great. I'll have a chance to talk to Jack, face to face in 3 or 4 weeks and, ask him some questions. What are the top few things investors can do with their time? So most of my day is not spent watching my stocks. Most of my day is spent talking to other investors, doing research, going through investor presentations, listening to earnings calls, reaching out to the companies, getting updates from investor relations, sometimes reaching out to the sales team at those companies and trying to get demos on the product, if it's a software type product. What else have I been doing? And then, of course, on StockTwits and Twitter, talking to other investors about stocks. But to be honest, that's where I get a lot. That's where I get a lot of my best ideas. I had someone on Twitter got me invested in Transmedics. Someone on Twitter got me into DermTech. Someone on StockTwits got me into Upstart. Or at least like brought these companies to my attention. I mean, I did the research after that, but I may not have found those companies right away. Maybe I would have found them at some point on my own. But StockTwits and Twitter have been phenomenal resources for me in terms of finding some of these companies as early as possible. So, I still wish that I had found some of them sooner, because a lot of these, even DermTech and Transmedics, even when I found them in January and February, they were both up 50% over the last, the couple months before that. So of course, I wish I found them even sooner. I mean, I could have gotten into DermTech back in November or December at like $10 or $15, but unfortunately, I didn't find it until January. Will big hedge funds always control the prices of growth stocks? I know. I just thought about this yesterday and today. I mean, I don't know how to answer it, to be honest. I could say no, but I think part of me doesn't believe that. Part of me knows how much money these funds have at their disposal, how much leverage they can access. And if they really want to short a stock, I don't think it'd be too hard for them. And a lot of these hedge funds have free reign to do whatever they want. Their investment policy statements, which sort of govern how they manage the fund, is like wide open. So if they want to take really, really concentrated bets, long or short, they can typically do it. And then, of course, they can, a lot of these hedge funds are buddies with each other, so they could bring in their buddies to join the party and short these stocks even more. But I mean, it doesn't mean that doesn't mean every hedge fund wants to be short every stock at the same time. And at some point, these prices get too low, and other funds, not just hedge funds, but other, mutual funds and institutions, they want to step in and buy these stocks at cheap prices as well. So, sometimes hedge funds are fighting each other on the long and the short side. It's not just hedge funds against retail investors or shorts against the longs. There's a lot of different, parties that are playing this game at the same time. So, that's, you could argue that's what makes it fun. That's what makes it interesting. I mean, investing is not easy. There's a lot of these stupid little games that get played. But you do need to have the, like a tough, just a mindset. Like you can't overreact day to day on certain, movements in your stocks. Now, I'm not saying that you should just hang on forever and never cut your losses, because that's probably not a good strategy either. But, if you're buying it, and this is what kind of frustrated me a week and a half ago, or maybe last week when I posted my StockTwits, I'm like, everybody keeps saying they're a long-term investor, but they're ready to, dump their stocks on every 10% pullback. And, you have to get away from that mindset. You can't be thinking, oh my God, my stocks are down 10% this week. Like, what if they go down another 10%? Yeah, they might. They might go down another 10% the week after that as well. But I mean, are you really going to try to time the exits and the entries and hope you get it right? Or are you just going to stay the course and, dollar cost average down when you can? Listen, if you have conviction in your companies, dollar cost averaging for me is 10 times easier than dollar cost averaging up, right? I mean, if I love a stock at 30 and it drops to 20, I can't wait to buy more. But if I love a stock at 30 and it goes up to 40, it pains me to have to buy it, $10 higher. I'm mad at myself for not buying more when it was at 30. So, how come your DD on Porch missed all the points in the short report? So I honestly have not read the short report on Porch because it's no longer a stock that I'm in. I just didn't take the time to read the short report. Like I said earlier, I think most short reports are garbage and they really manipulate the truth or literally just outright lies. So part of me is I don't even want to give credit to the writers of the short report by reading it. But genomic stocks that I recommend. So, because DermTech is one of my biggest positions, and that's technically a genomic stock. That's the only one that I own right now. There's others that I watch, CRISPR and was it Nvidia. It's NVTA. I've never actually owned it. Oh, Invite, NVTA, Invite. That's a one that's liked by a lot of people, but I don't personally own it. I've never done any due diligence on it, so I really can't tell you one way. I can't even tell you what they actually do. I mean, I know there's like 3 of them. I know there's a whole bunch that ARK owns. If you want to look at genomic stocks, go look at the ETF that ARK runs, ARKG. And I know it's like their top holdings. It's NVTA. It's EDIT, which I believe is Editas, and then CRISPR. So like those are 3 of their biggest holdings, I think, still. So that's probably a good place to start. You know, if I mean, even though, like I heard someone on Twitter say, "Oh, I wouldn't buy DermTech because ARK doesn't own it," which I think is stupid. But you know, if ARK does own it, like if you do want to be in genomics and ARK owns it, it's probably a little bit of like, you know, the stamp of approval because they've obviously done their due diligence on it. But ARK, you know, the problem with ARK is they have so much money to manage right now. If anyone hasn't been following them for the last couple of years, I mean, they have just absolutely crushed it on performance. A big reason was they had their largest position was Tesla, and Tesla went up 15x over the last 18 months or 10x. So ARK's funds obviously benefited from that. And then their genomics fund has crushed it. Their fintech fund has crushed it. And because of all that success, they've seen a massive inflow of assets into those ETFs. So I think ARKK, which is kind of their flagship ETF, has 22 or 25 billion in it right now. Their genomics ETF has, I think, over 10 billion now. So the problem is, like, as those ETFs get bigger and bigger, it's going to be harder for them to buy smaller stocks because those smaller stocks have smaller market caps, they have smaller floats, they have less liquidity. And at the end of the day, like if you're running a $25 billion fund, like it doesn't even make sense to have a 1/10 of a percent position in a company, because even if the stock tripled, it wouldn't move the needle for your performance because it's such a small piece of your fund. So at some point you just have to say, okay, like even though we could own, even though we could have, 1/10 of 1% of our fund in this stock, it's not going to move the needle. So why are we going to allocate our time and our resources to doing the research into that company if we can't even own enough to move the needle? And that's sort of what ARK is going to run into right now. Is they're going to have, like they may not be in DermTech because DermTech is just too small for them. They may not be in ClearPoint because ClearPoint is too small for them. I don't know. I'm just guessing, but it's possible. Am I single? Yeah, so I saw some personal questions. Yes, I'm single. No, I don't have kids. I don't have any kids. Yeah, that's it. Oh God. For leaps that are at least 12 months out, how do you determine when to trim? I've actually never bought a leap before in my life. So, but yeah, I mean, I can't really give you advice on when to trim leaps. I think just everything comes down to your conviction in the stock and where you think it's going. And, there's nothing wrong with taking profits. I mean, I do think the rest of this year is going to be pretty choppy. So, this is last year, taking profits was actually the wrong strategy because the markets just kept going higher, thanks to the, not just the bottoming out in March, but, all the stimulus money from the Fed and the Treasury. So last year, most of the stocks that I trimmed last year ended up being the wrong decision because those stocks finished the year much higher than where I trimmed them. This year, I think, is a little bit different. I think this year is going to be more choppy. So I think this is the kind of market where you want to take advantage of that volatility and use that choppiness, as part of your strategy. And, as they say, trim the rips and buy the dips, or sell the rips and buy the dips. Let's see. Since we agree you're a better investor than me, and since you have generously shared the exact breakdown of portfolio, why would it make sense for me? Okay, this is a good question. I think I actually might have addressed this earlier. So I'll repeat it again though. So this person's saying, since you're a better investor than me, why should I not just copy your portfolio? So here's the problem. And this is, if you want to cut my portfolio, I think joining my stock twits room either now or when I get the real-time alerts is a good idea, because this will help you. But here's the problem. If you just copy my portfolio, so even if my portfolio was still pinned to my Twitter account, which it's not, I took it down a couple of days ago. If you see that my top position is, let's just say it's, well, let me use an example here. Okay, so Celsius. Celsius has held up really nice the last few weeks. It's barely, actually, it's up. It's up the last few weeks, maybe 20%, 25%, where most of my other stocks are still down over the last few weeks. So let's just say, for instance, Celsius was the biggest position in my portfolio, and it was up 20% in the last few weeks. If let's just say you start with $100,000 and you looked at my portfolio and you saw that Celsius was my biggest position at 10%, you might, say, okay, fine, I'm going to, out of my $100,000, I'm going to take $10,000 and buy Celsius right now, because that's Jonah's biggest position and I trust Jonah. What you don't know is that Celsius became my biggest position because it's up 25% in the past few weeks, while everything else is down 25% in the past few weeks. So even though I like Celsius, it's my biggest position for those factors. And because of those factors, it's one of the stocks that I have not been adding to aggressively recently. As it's been going up 25%, I've just been letting it go. I haven't trimmed anything, but I also haven't added to it. Whereas, some of my other stocks that have been falling back, Upstart, Futu, Mohawk, etc., I have been adding to them. And this is what happened back in February, where, Futu, Upstart, Mohawk, DermTech were all up 100, 200% to start the year. So they became my biggest positions, and that was fine. I still love those companies, but I wasn't adding to them. But someone that saw my portfolio on Google Sheets just assumed that they should be copying my portfolio without even thinking about whether or not I was actually still adding to those stocks. And there was really no way for me to tell them that I was or I wasn't. People were just copying my portfolio blindly, which was not the right thing for them to do, but there was also not really any way for me to, stop them or instruct them otherwise. So, there's nothing wrong with copying a portfolio or adding some of my names to your portfolio. You just want to be mindful of how they've performed recently, and then try to figure out if I've actually been adding to those stocks. So, like I said, I haven't added to Celsius in over a week. But yesterday on the pullback, I added to Upstart and DermTech and Mohawk and Futu and ClearPoint. So those are the stocks that I'm still adding to. And if Celsius runs up another 15, 20%, there's a chance that I actually trim it back a little bit and add to some of my laggards in the portfolio. So, there's nothing wrong with trying to copy a portfolio, but you run the risk of chasing stocks at their highs when the person that has the original portfolio isn't even adding to those companies right now. They're waiting for a pullback. Thus, you should wait for one too, if you trust them. Oh, that's a lot of questions. Let me see, 8:10. Okay, I'll do. Hold on. If you believe that the stocks you see most upside next 3 months, you still early, or when you purchase call options. Yeah, so I agree. For me, the best time to, buy call options would have been yesterday morning when everything bottomed out, or the day before when I thought we had capitulation in growth stocks. Buying them at the bottom is obviously the best time. I would agree that, options is going to add some leverage to your portfolio. So, if you own the underlying stock and the stock goes up 10%, if you had options in that stock, they might go up, 50, 60, 70, 80%. So, you can get a lot of leverage with options. You just run the risk that the stock doesn't go up like you think it's going to, or doesn't go up enough. And those options expire worthless. And then you've just lit a bunch of money on fire. But yeah, I agree. So, if we ended up seeing, and shame on me for not jumping on this strategy a couple of days ago, which I actually talked about in my stock quits room, I just never actually acted on it, was if we do get another pullback in stocks, in my favorite stocks, there's a good chance that I do trim some trim off some of my shares, let's say 5% in my highest conviction stocks, and then use that money to buy to pay the premiums on some call options. Options, I'm definitely not an expert on options. I should not be teaching a session on options. In many ways, I should be listening to a session on options. They've never been part of my strategy, for the last 20 years. So why do you feel that owning 50 stocks is too many? Yeah, everyone has their own preference. I mean, I know people on Twitter that have 40, 60, 70, 80 stocks. I know other guys that have 5 to 10 stocks. So, it really comes down to, there's no way that you can have 50 stocks and have high conviction in all of them. You might like the company, you might think, you like the upside, but there's no way that you have high conviction in all of those companies, especially, high conviction at the same level. So, this is just how I do it, there are, I don't know, like I usually say, as the market goes higher, I tend to, that's when I tend to trim my winners and look for new stocks to add that might be recent laggards, and therefore pulling back to a moving average, but still have the fundamentals to give me some, to make me think that they're going to bounce off of that moving average. And that's sort of what I was doing the first 6 to 8 months of the year, as Futu was ripping, and Upstart and DermTech. I was trimming back those stocks a little bit, and then looking for other stocks that were pulling back to a 10, 20, 50-day moving average, or looking for SPACs that got me really excited. And SPACs were hot, and we all thought they would just keep on going higher. I kind of got, sucked into, trimming the winners, which was fine. That actually worked out to be the right decision. But, I was adding to too many other speculative stocks. And unfortunately, when growth pulled back, or small cap growth pulled back, they all pulled back. I didn't have there really wasn't any balance across my portfolio. It's not like I had any large caps or value stocks to balance things out. It was just 30%, everything at the same time coming down. So, and that was fine. I had a cushion to fall back on. So I could absorb it maybe easier than others, but still painful, to be way off the highs like this. Would you take club money up front for your ETF in return for reduced fees? I'm not even sure what that means. Would you take club money up front for your ETF in return for reduced fees? Feel free to message me on Twitter and explain that to me, because I don't get that. Oh yeah, I didn't even realize that the lights aren't on. It was light out when we started, so my apologies. Are you more bullish on Futu or Upstart? It's a good question. Let's say I would say Upstart, because Upstart doesn't have the Chinese risk that Futu has, and Futu, that's probably the only reason. The fundamentals are pretty comparable, at least top line growth is. Futu has better margins, much better margins, actually, both EBITDA and net income. But Upstart, I don't know exactly what the TAM is for Futu. I don't know exactly how many potential customers are out there in Asia for them. I think it's probably a ton. I also don't know what competition is coming down the road for Futu, and Futu probably has a little bit less, moat around the business, less competitive advantages, even though they have very strong brand. Anyone with capital could go out there and create a similar app and go out and acquire customers. With Upstart has an 8-year head start with their AI. So any other company that wanted to come in and compete against Upstart would have years of work to do to, build or to acquire or accumulate the data that Upstart already has. So I think from that standpoint, plus, Upstart has the ability to expand into many other, what I call credit verticals. They started off in personal loans, 1,000 to 50,000. And they're now expanding into auto loans, which is huge. But then they could also get into mortgages and small business loans and student loans and credit cards. So I think there's more expansion opportunity for Upstart than there is for Futu. So for that reason, I would give a small, I don't know, what's the right word? I don't know, favoritism. But I mean, they're both in my top 5. And in terms of like percentage, they're within 4.5% of each other. So if you do not post your portfolio on Google, what is stopping these shorts to sign up for StockTwits and StockTwits to short the stocks in your portfolio? Yeah, they could. I mean, I don't know. I mean, a lot of these stocks have already fallen so much. I'm not sure, like I said earlier, I'm not sure that the shorts really want to be short these companies still going into earnings. So, so frequency, yeah. So I was just reading an article on frequency last night. That's a tricky one. So I had a very small position in frequency that I got even more excited about when they released their what's called half trial data, which showed. So if anyone doesn't know, so frequency created it's kind of sort of like one of these regenerative medicines. So it's an injection in the inner ear that is meant to help regrow the hairs that help with hearing. They call it like the Sensio. I forget the exact name of the cells. Then there's like the progenitor cells, I think is how you pronounce it. But anyways, so the company released the half trial data, which said that which looked promising, and it was a very, very small trial with I don't know, 24 patients, I believe. But comparing the patients to the the placebo, I guess is what you call it. It looked very promising. The people that received the injection could hear words more clearly than the people that didn't receive the rejection. Or I forget exactly, it might have been, I don't know. They did a few different trials with different with a different setup. So in some of the trials, they used people like one group did get the injection, one group didn't. In another trial, they used people got the injection in one ear but not the other ear. So then they try to compare ear to ear, which is, I mean, it's all hard. I mean, it's very hard to set up a placebo in that sort of situation. And then they had another trial where they did multiple injections. They did 4 injections in the ear 1 week apart. And I think what really killed the stock was that when the data got released on that last trial, where it was 4 injections 1 week apart, they didn't show any difference in results from the before to the after. And then the CEO of the company said maybe it was because they were overwhelming the ear with the number of shots. And then it appears that just the one single injection actually got them better results. So I don't know. It's good. I mean, I'm out of the stock right now. I sold it, took my loss. I sold it for it was a very small position, but it was still a big drop in terms of percentage. So, I mean, it didn't really impact my performance on the year. It just kind of annoyed me because after getting the half trial data, I got all excited that I thought we were going to get some really good full trial data. And then we got hit with the big disappointment. So the stock dropped 75 or 80%. I forget what it was. But the report that I read, and I think it's on Seeking Alpha, if anybody wants to find it, was basically saying, don't count the company out yet. They're going to go kind of back to the drawing board, stick with the one shot, but now do a larger trial. So I don't know. It's just frustrating. Like, it's one of these companies that everything sounds great, sounds promising. I mean, it's a massive, massive opportunity if they actually get the therapeutic correct. But this is what happens with these sort of biotech therapeutics companies. A lot of them they're binary outcomes. You're either going up 100% on the trial data, or you're going down 80% on the trial data. And sometimes it really feels like a crapshoot either way. So why don't I buy warrants? So one of the reasons I don't buy warrants is it's one more thing that I have to track and explain to others. So if I'm going to be transparent with people, or at least when I was being transparent, and I show that I own warrants, then that means I have to explain those warrants and what they are to every single person that looks at my portfolio and doesn't understand them. And I didn't feel like having, 100 of those discussions every week in my DMs. So I decided to stay away from them. Sorry, I wasn't able to look at your session completely. What would be the replacement for your active trade sheet? I mean, the closest thing to the Google sheet would be joining my stock Twitch room, I suppose. And I talk a lot in there about my my portfolio, what I still own, what I'm trimming, what I'm buying, selling. So you mentioned you'll probably do some mid caps. Yeah, that's true. So I think until I'm sure that the shorts are not going to keep coming after my stocks, I probably will increase the market caps of the companies that I'm writing about. So a lot of the recent stocks were market caps under 1.5 billion. I'll probably increase that to 4 to 6 billion or 3 to 6, somewhere in there. So, and we'll see how that goes for a little while. I mean, there's a lot of companies out there that I can still get excited about in that, $1 to $10 billion range. So I don't think I'm going to have a problem, but I don't think every week is a good idea. I really want to have conviction in the stock before I write about it, because I do think people take the write-up more seriously if they know that I believe in the company or that I'm bullish on the company, especially if I have a position. And I mean, I don't think I want to do a write-up on a company if I don't have a position, unless I'm only doing write-ups to really bring these companies to everyone's, bring these companies, make you aware of these companies. I mean, I've been thinking about this, like, does it add value if I'm doing a write-up on a company and I think it does from a neutral standpoint. So I'm not bullish, I'm not bearish. I do like the company, but there's some things that I don't like. Here's all my research. This is, and then kind of lay out my thesis, kind of pick the whole company apart, and but I'm more neutral on the company. So I don't have a position, but maybe it's a stock that I like enough to keep tracking and continue doing more due diligence on, and maybe I can interview the CEO. But I'm not at that point yet where I have enough conviction to start a position. Like, I think there is some value there. I don't know if I have to have a position in every single company that I write about, but I have to think more about that. Yeah, StockTwits is $10 a month. Has a high frequency hearing loss and I suffer. Yeah, I hear you, man. My dad has really, really bad tinnitus, and I know a few other of my friends' parents do as well, and it's brutal. Yep. From what I mean, it's like a constant buzzing or ringing in your ear. It's just, I can't imagine. So I was also very disappointed in those frequency results. Okay, that's it. 8:30. I gotta drop off. I didn't get a chance to go through any charts tonight. There were more questions than I was expecting. So maybe what I'll do is next week I'll set up another one and we can go through some charts. To be honest, I was actually supposed to do a session with TrendSpider last week, but I canceled it because I just felt like the small cap stocks were still in free fall and the charts looked absolutely horrible. I mean, a lot of the support levels and moving averages were breached, so there really weren't any great setups in any of the charts that I track. But now that we've hopefully found a bottom and we're starting to move higher in some of these names, maybe some of these charts start to look constructive again with some interesting entry points. Although I'm not sure anyone is actually sitting on cash right now. I mean, I don't have any cash in my portfolio, so I'm fully invested right now. So even if I saw some setups that I really liked, I wouldn't be able to add them anyways. And that's sort of one thing that I constantly struggle with. There are a lot of other stocks out there that have fallen to some pretty low levels that I haven't owned yet, but I've been watching them and I'd like to start positions. But in order for me to start a position, I would have to sell something that I already own in order to raise the cash. And that's where I struggle. If I already have high conviction in my current companies, do I want to sell them or trim them to go add another stock to my portfolio that I haven't had high enough conviction in until the price dropped by 50-60%. And that's a struggle for me. So I don't have an easy answer for that one either. Okay. So I gotta run. I gotta eat some dinner. I hope you guys enjoyed this. I hope this was helpful. You know where to find me. I'm on Twitter all the time. My DMs are always open, and you guys always have my email. So if you have any specific questions for me that I can address for you, or try to add some value, let me know, and I'll try to set up another one of these calls in the next week or two, and we can go through some charts or any questions I didn't get a chance to answer tonight. So thank you very much. Thanks for joining. This was all recorded, so I will get this. Actually, I'll probably put it on YouTube tomorrow, and then I can send out the YouTube link to all of my subscribers. I think that would work all right. So, okay. Good night, everybody. Have a good one, and hang in there. Our growth stocks are starting to bounce, and I think we're going to finish the year strong. So just be patient.